Governments generate most of their revenue from taxes. Taxes are probably familiar to many of you. Our income taxes are paid when we earn money. Our sales taxes are paid when we buy goods. And our property taxes are paid when we own properties. Most countries have income taxes, except for a few. The United Arab Emirates, for example. Taxes in most other countries can be divided into three categories: taxes on earning, taxes on purchases, and taxes on possessions. From the grocery store to the hairdresser, we can hear the loud sound of tax take almost everywhere. Taxpayers today have access to the advice almost instantly thanks to their smartphone and social media accounts. The more it's shared, the more legitimate it appears to taxpayers. But here comes the question: are those advice true? Hi there, I'm Melisandra. I like to learn and find out the truth behind this myth. Based on the most common tax myths, I did my research and consulted my accountant. Here is what I would like to share. Tax myth 1. You have the option of choosing your filing status. In the federal tax system, you can choose one of the 5 filing statuses: single, married, filing jointly, married, filing separately, head of the household, and qualifying widow with dependent child. When a life event occurs during the year, such as a marriage or divorce, taxpayers often find it confusing. In contrast, a person's marital status is determined as of the last day of the calendar year for federal income tax purposes. Married couples are considered married for the year if they are married on December 31st. In accordance with the laws of your state, you are not married if you have never been legally married, or you are legally separated or divorced as of December 31st. Whatever happens between now and then doesn't matter.
Tax myth 2. Expenses are always deductible. By reducing your taxable income, tax deductions reduce your tax liability. That's great, isn't it? Many people tend to eat up expenses simply for the sake of deductions. You're still spending money, so don't be fooled. Even if the costs can be deducted, they should be ordinary and necessary for both individuals and businesses. Even if the deduction saves you 25% in tax, you are still out of pocket because it reduces your costs by 100% less the 25% tax savings. Make sure the investment is worthwhile before you make a purchase. Tax myth 3. State and local tax deductions prevent double taxation. In order to broaden the individual income tax base and pay for rate reductions, the Tax Cuts and Jobs Act of 2017 capped the deduction for state and local taxes. The SALT deduction, although many have viewed it as a positive reform, has remained an important protection against double taxation. It is often argued that the coexistence of federal and state income taxes in the United States constitutes double taxation. Federal, state, and local taxes are all used separately to fund each level of government's distinct set of services. A case of double taxation occurs when more than one tax is imposed by the same government or by other governments of the same kind. It is not necessary for an Idaho-based company to pay income taxes to New York and Idaho on $100 earned in New York. If it paid income taxes in New York on those $100 of profits, it should get a credit on its Idaho tax return. A policy like the SALT deduction does not hold up when multiple levels of government impose taxes on different services. Tax myth 4. Large corporations do not pay tax. There are some years when some corporations pay zero federal income taxes, often those that appear profitable. However, there are no tricks or loopholes involved. Corporations that are profitable do not have to pay income taxes for several legitimate reasons. 2 factors contribute to this misconception: a misunderstanding of what corporate income means, as well as a misunderstanding of how corporate income is taxed. Many companies you think are profitable won't actually make a profit this year, according to reports. As a result, companies report what's called book income on their financial statements, which follow standard U.S. accounting standards and are designed to present a positive picture of profitability. It is important to note, however, that the tax code uses different accounting rules. In order to calculate taxes, governments use something called taxable income, which takes into account 3 important factors. Taxes on net operating losses. The U.S. tax code allows companies with losses in one tax year to deduct those losses from profits in future tax years all the way down to zero, preventing corporations with long-term net losses from paying taxes. where a company earns its profits. To mitigate double taxation, the US offers tax credits to large companies that operate in more than one country. The amount of equipment and machinery that a company invests. Capital investment purchases, such as new equipment and machinery, are the most significant difference between book income and taxable income. When a corporation makes a capital purchase, it is only allowed to treat a small fraction of that expense as a current year expense and must write off the investment over time. In contrast, corporations in the United States can deduct a much larger fraction of the same investment from their taxes in the same year that they make the purchase. In other words, next time you hear about a profitable company paying no income tax, chances are they have zero or negative book income and either substantial foreign profits, large capital investments, or all of them. In addition to federal income taxes, corporations also pay state and local taxes. Tax myth 5. Taxes on businesses only affect business owners. Business taxes are commonly misunderstood to be the sole responsibility of businesses. On the surface, that makes sense, but in reality, workers are also responsible for a large portion of the burden. According to studies, workers bear more than 50% of the corporate income tax burden. In the U.S. Department of the Treasury, Congressional Budget Office, and Joint Committee on Taxation, Congress's official tax scorekeepers, their estimates split the corporate tax burden between capital and labor. What are the odds that workers have to pay a tax that they don't even pay? Tax incidence refers to who is legally obligated to pay a tax, while economic tax incidence refers to who indirectly pays for a tax, often through lower wages. Business decisions are affected by taxes, which can be understood by understanding how taxes work. Imagine a business owner who is deciding whether or not to upgrade her staff's computer equipment. This decision will be based on how much more productive her staff will be if she purchases new computers and, by extension, how much revenue will be generated for her business. In her cost calculation, taxes, sales and property taxes, deductions, income taxes will play an important role. The impact of business taxes goes beyond business owners. Taxes on businesses increase investing costs, which means business owners will be less likely to invest in equipment, buildings, and training that will improve employee productivity. As a result, employers will have to pay their workers less as they become less productive. Tax myth 6. Employees can claim the home office deduction due to the pandemic. During the pandemic, many of us are working from home. You may be required to work from home by your employer in some cases. The internet and other expenses associated with the home office are excellent reasons to deduct them. That's not the case. Home office deductions are no longer available to employees working from home for the tax years 2018 through 2025 under the 2017 tax law. The reason you're working from home doesn't matter because there are no hardship exemptions or pandemic waivers. Tax myth 7. Gambling losses are easy to deduct. My Vegas trip didn't go well. I just lost a bundle there, but I'm writing it off. You shouldn't count on it. The IRS is very strict when it comes to deducting gambling losses from income tax returns. Throughout the year, the IRS receives tax returns from people claiming that their gambling income is minimal but that their gambling losses are substantial. In terms of gambling losses, the IRS has a simple rule. Taxpayers can only claim deductions on losses equal to or less than their winnings. For example, you may win $800 gambling in 2022, but you may lose $1,000. You will only be able to claim $200 in losses on your 2022 tax return. As long as you lost your money through gambling, the IRS is not particular about how you lost it. Whether you lost at the track, the craps table, or the roulette wheel, it doesn't matter. The $500 you win in the lottery can be used to claim any $500 you lose at the casino or in fantasy football. You should be aware that gambling income and losses may trigger an audit by the IRS.
Okay guys, thanks for watching. Subscribe to my channel for more future updates. I'm Melisandra and see you soon.